Hi everyone, welcome to another video lecture. This is for Chapter 2, Professional Standards. And kind of, the big picture here is that professional standards came about as a kind of a collective response to a series of damaging frauds that the auditing profession has experienced over its history, right? And so some of that goes back to the late 1920s, early 1930s. Some of that in the 70s, and then more recently in the early 2000s, late 1990s. And so, we tend to have this kind of process of crisis, demand for action, and then some kind of response from either governmental agency or a standard-setting body. So that's just a little kind of a general pattern that we see throughout history. So we're going to talk a little bit about standards today. And just like before, we have these learning objectives. So I do have the priorities listed. H is just high, M is medium, L is low. And so I'll go through this, and again, I do these priorities because this is how I'm going to test, and this is what I think is the most important for you to try and remember, okay, and learn. So look at the first one. It's important. Describe the authority of the two types of the auditing standards in effect, AICPA and PCAOB. Right? And so we really have three sets of auditing standards, two that are U.S. based, one that's international. The AICPA has the Auditing Standards Board, which we mentioned last time, and they set auditing standards for audits of non-public companies in the U.S. Historically, they set the standards for all audits, but then when the PCAOB came about, they basically took authority or responsibility for setting standards around audits for publicly traded companies in the U.S. Okay, so private companies, kind of non-public companies, they're under the AICPA auditing standards, and audits of public companies are under the PCAOB auditing standards, AS for short. There is an international auditing standards board, and different countries recognize their authority to set auditing standards. And there's different levels that different countries give weight to that. We're not going to talk about those, but just recognize those are out there. So some authority, what are they actually able to do? There's a lot of similarity, but there's some differences too. So the PCAOB, they set the auditing standards. They set standards around attestation, how you actually do it, quality control, which we'll talk about, independence, and then ethical standards. The AICPA has a similar list. The one difference is that they also have a set of accounting and review standards, which I mentioned in Chapter 1. And so they would also kind of have some authority over that through their Auditing Standards Board, which is essentially kind of like an entity within the AICPA. Okay, and then the state boards of accountancy are also groups that have authority here in this space, because they're the ones who actually license the CPAs as individuals and license the CPA firms to practice in their states. And so you really kind of have potentially three. So one CPA firm that does public audits of publicly traded companies and does audits of non-publicly traded companies that's located in North Carolina, for example. They could potentially have to deal with all three of these organizations because of who they're doing business with and where they're doing it. When you look at the PCAOB, there's 5 members, only 2 of them can be CPAs. They're trying to get some diversity of thought, I guess, make sure that the stakeholders have some view or input rather into the standards process. They're appointed by the SEC, and they have 5-year terms. All the accounting firms that audit SEC firms, SEC companies, have to be registered with the PCAOB, right? And so the PCAOB, which we'll talk about in a little while, has oversight responsibilities, and so you're basically putting yourself under their authority in order to be able to audit the SEC registrants, right? And they actually have some teeth, right? They can impose monetary damages, they can suspend you from doing audits of publicly traded companies, and refer you to the Justice Department for criminal actions if necessary. This is a summary figure that tries to kind of lay out differences between audits for public versus non-public. It's just something that is largely the things we've been talking about. So this is a good kind of summary figure if you want to just look at this when you think about this first learning objective. That would be a good go into study. So learning objective number 2, 2.2-2, identify the nature and underlying principles of generally accepted auditing standards. It's kind of medium objective. So one of the unfortunate things about auditing is there's a lot of lists, and so that's why it just takes a lot of time for you to read, go through, listen. So kind of the best way to succeed is reading the chapters, watching the videos, engaged in class, come back, look it over again, do the Learn Smarts, do the homeworks, right? You just need a lot of time to interact with this for all these lists to kind of sink in, and that's unfortunate that there's so many, but that's just kind of the nature of what we're doing. So we have 6 principles here that are a part of a GAAS audit. The GAAS just means Generally Accepted Auditing Standard, and it's really kind of been changed to just AS with the PCAOB, but this is just kind of a legacy of how we always used to talk about it. So we'll go through these principles. First, the purpose of an audit. We talked about this before, right? We're basically looking at the subject matter, which is the financial statements, and we're going to make sure that it adheres to GAAP, right? So that's kind of a straightforward purpose. The premise, one of the underlying premises, is that management has to prepare financial statements, not the auditors, and they have to provide auditors with the information they need to get access to the accounting records and any underlying transactional records that they need to collect evidence, right? So that's kind of the management's responsibility. The responsibility of the auditor is to make sure that, for example, if there's multiple individuals on this engagement team, that you have the right skill set of individuals, right? That's the competence piece. You make sure that all your, for example, associates have degrees in accounting, right? They've sat for their CPA exam, maybe that. Hopefully, most of them have passed it. That's fine for some staff to not have passed it, but you better have seniors and managers that are CPAs, right? So competence is one piece, and then the other piece is really independence, okay? And so that's what this discussion about professional skepticism is. It's making sure that you're not just taking what managers say at face value. You're actually going in and saying, okay, that's a good assertion. This is why you set the bad debt expense the way you did. Now go ahead and provide me evidence that I can verify your reasoning, your thought process, the inputs you used to decide what the bad debt expense was. And so you need to kind of continually have that amount of skepticism. And we'll talk more about independence as we go along, but competence, independence, those are the 2 big things that we'll have to come back to, because they really dictate and determine whether or not you're going to be able to do a quality audit. And so then kind of another important principle here is that auditors can't get to absolute assurance, right? It's impossible. There's no way that you can get to absolute assurance because of the nature of what you're trying to do, the nature of the audit procedures you're running, the fact that you have a limited budget and there's a limited cost, right? There's only a certain amount of money that the audit committee is willing to pay the auditors in order to come in and do an audit. And so all you can get to is reasonable assurance about whether there's any material misstatements or not in the financial statements. Okay, so a lot of times individuals assume that we get absolute assurance, but it's just not practical. Another kind of the last principle here for our audit is that the results that we report the results in a timely manner, right? Usually that for a financial statement audit, that's an opinion. It's always attached to the financial statements. If you look up 10-Ks from a firm that they file to EDGAR, to the SEC, then you will find the audit opinion right after the financial statements are presented. And same thing for an annual report. If you see the financial statements, you almost always see the audit opinion right after. Okay, and so again, that's where we're verifying and confirming, do we believe that the financial statements fairly reflect the financial performance and condition of the firm that's presented in the financial statements. The hierarchy, standards are not written in a way such that every single possible issue is always laid out in the same level of detail and precision, right? And so there are situations where you might have a new transaction come in or a new type of evidence you're trying to collect, and so it may not have made it to the auditing standard yet, right? And so and maybe you have to look at some of the interpretive publications that either the AICPA puts out or the PCAOB might put out, or other. You might have to go farther down and look at other auditing publications, Trends and Techniques, Journal of Accountancy articles, other things to try and provide some comfort, right? So, there's a hierarchy here, so you have to look to see what do the standards say first before you can move farther down. Yeah. All right, then the next learning objective here is what is the auditor's responsibility for detecting errors and frauds? And so the assumption a lot of time is that the public assumes the auditors have complete responsibility to detect errors and frauds. But the reality is you can't have complete responsibility. Again, just like you can't get to complete assurance. So what do you have to do then? Well, you're trying to assess what are the risks related to fraud, what are the risks that are inherent to the company as far as misstatements. And so we're going to go through this as we learn about how to do audits. How do I assess these risks? And so there's several steps we're going to talk about in a lot more detail when we get there. But you try and obtain that information, and then you assess the risk that errors or fraud may occur. And then you basically plan your audit to get reasonable assurance that we will be able to detect those material misstatements before the financial statements are published, right? So we're getting kind of draft versions as auditors of the financial statements. We're collecting a bunch of evidence, and then we're trying to plan it in a way that we're going to get reasonable assurance that we'll be able to detect the material misstatements. And then a really big important thing is this idea of exercising due care. Whoops. Where are we at? There we go. So exercising due care is really, let me undo that. So exercising due care when we plan and execute the audit is going to protect audit firms a good bit from any liability, and we'll talk about that in the next, I believe it's chapter 4 actually, and so that's going to be really important, and it's going to provide a lot of protection. All right, so the last, let's see if I can clear this out here. The last piece in this learning objective is related to what about just general non-compliance with other laws and regulations. Not necessarily talking about material misstatements, but non-compliance, or potentially just thinking about non-compliance. So what's the auditor's responsibility there? So the place that we really have to care about it is if there is a direct material effect on the financial statements. And so we'll design our audit in a way to make sure that might be the case, right? So if there is a large environmental lawsuit, for example, because the firm, dumped, toxic waste or something, contrary to the laws and regulations. Well, that could have a direct and material effect, right? If there's a significant lawsuit that's large enough for it to be material, then that would be something that auditors would have to go and investigate. For other things, in terms of no direct effect on the financial statements, then we have auditors have a much more limited responsibility. They're inquiring of management as to are they in compliance with some of these other laws and regulations. They'll look for letters from either licensing or regulatory authorities, right? If you're for example, a bank and you're under the FFEIC, then you'll ask to see what kind of correspondence they've had with that regulator to see if there's any issues there, and then you'll look for, or then if you find any information, or if someone brings it to your attention, then you have to evaluate whether noncompliance has occurred. But at the end of the day, we're auditing financial statements. We're not auditing compliance with all these other laws and regulations, right? Just imagine a place with a lot of employees. It's a manufacturing. They have a big manufacturing plant. The auditor's job is not to make sure that OSHA, the Occupational Safety and Health Administration, all their rules and regulations are followed. That's not something a financial statement auditor is responsible for. Now, if it comes to their attention that there's some significant violations, then they would look to see and kind of have to investigate some non-compliance and make sure that it's actually been reported to the appropriate authorities. But they're not required to go out of their way to try and find, as auditors, non-compliance with these other laws that don't have a direct effect on the financial statement amounts.